Crypto exchange Huobi says it will cut staff by 20%. Shopify merchants can now design, mint, and sell Avalanche NFTs. Animoca brand slashes Web3 fund target to $1 billion, down from $2 billion. Metaverse leaders at Consumer Electronics Show see possible side hustle in selling personal data. Hello, everybody, and welcome to the Assets of Value podcast. Today, on January the 6th, and every day, we connect to share our insights and perspectives on crypto, Web3, and NFT topics. We are the founders of Assets of Value, a Web3 research organization. Our podcast is not to be taken as legal or financial advice. Let's jump straight into it. Abe, how's the market looking like today?
Rob, the market is pretty much boring at this point. Bitcoin is trading sideways as altcoins lose major support zones. On top of that, we are seeing a re-emergence of AI and big data related tokens pump, and that could lead us to an extended run for AI tokens, including the big names like Fetch AI, Ocean, and so on.
Okay, interesting to see AI tokens pumping. It's been a while since they have. Right, let's jump straight into it with our first piece. Exchanges, this time is Huawei, and it is about to cut staff by 20%. This suggests to me that they are continuing to feel the squeeze and the pressure of this continued bear market, and potentially traders are nowhere to be seen. I mean, price action is going sideways. There isn't much volatility, and where exchanges do make their revenue is via trading fees. What's your take on this?
First of all, Huobi was one of the largest exchanges, centralized exchanges in the world. But once they lost their status and stability in China, they lost the big game. Later, they shifted to other regions, including Asia Pacific and everything, but they couldn't capture users, they couldn't capture the market also. Later, we came to know that Justin Sun is investing in Huobi, and he literally owns most of the Huobi exchange itself. Now let's see it from a different standpoint. Who is Justin Sun? Justin Sun is the founder of Tron, and Tron has a pretty crispy ecosystem, including USDD, which is about to be depegged, while it has already depegged once or twice. He's the person who offered to help FTX out of its situation. He's the person who first deposited $100 million into Binance when there was a FUD surrounding Binance. So you see this figure of Justin Sun everywhere, almost everywhere in crypto industry. And what he does is he invests a lot back into the system. So when you hear that Huobi is trying to cut staff and later they proclaim that they are cutting staff, you realize how far the bear market has gotten into them. Huobi is not making profit. Huobi is having a liquidity situation. Above all, Huobi is governed by a inadequate and ineffective leadership. That's the story in short.
Thanks for that additional context around Justin Sun. I was exactly thinking, why does that name keep coming up? Yes, heavily involved with Tron, and he always there whenever there's some news to either help out or extinguish or even maybe put his name back into the circle of relevancy. And you're right, in terms of Huawei and taking a haircut in terms of staff, something is actually deeper afoot here, because when you got his past actions of trying to offer cash and liquidity for cash straps organizations, his own one is actually struggling. There could be something deeper to this one. I don't think we've heard the last of sad stories around job losses and particularly crypto exchanges. They seem to be quite struggling at the moment. Let's move on to something more positive. And Shopify, a well known Web2 e commerce provider and platform, is expanding its NFT integration, allowing millions of its merchants to begin designing, minting, and selling Avalanche NFTs. Why Avalanche NFT? I don't know, but it's using the Venly Shopify merchant app, and storefronts can sell NFTs with minimal technical knowledge. Now, I think this is really bullish for people to be exposing, especially merchants, to be minting their own NFTs, but also to exposing their customers and onboarding them in a Web2 e-commerce framework. But still, I'm not sure why and how Avalanche was used. Such a chain like Polygon would have made more sense.
Of course, I was of the same opinion that Polygon is a better fit. It has a product to market fit. It has a lot of backing. It has the safety and security net of Ethereum. It is adored by decentralized community. But Avalanche has a totally different proposition. Avalanche is seeing massive expansion in its throughput, and anybody who wants to use an EVM system can easily use Avalanche because it's cheap, it's fast, although not decentralized enough. It has a standard ecosystem with NFTs, with some games, with DeFi, and everything. However, I think Shopify did a mistake here because they should have went with Polygon or simply Ethereum or any of the layer 2 solutions. Now what will happen is I'm not quite sure if Avalanche will stay in the limelight in the next bull run. And all of these users and all of these merchants who minted NFTs will not be accessing the NFTs. Imagine you are a new Web3 user and you have some specific NFTs in your wallet, but you no longer can access it because the chain isn't working anymore. I hope it doesn't come to such a situation, but if that happens, what will be the first impression that users leave with Web3?
Great points there. I mean, AVAX, the actual ticker for Avalanche, has been out of the news for quite some time, and it's making a comeback here. I've just pulled up the chart and it's trading at $11.58 at the moment. At this highest time, it was well over $125. So it's had a massive fall from grace, as has all cryptocurrencies. Is there a risk that actually AVAX could fold? And then on the positive side, could it retain those all-time highs again?
First question we should ask ourselves is that who is building on Avalanche? Secondly, whether Avalanche has enough volume to be compared with Ethereum or even Polkadot or Polygon. Thirdly, what is the ecosystem doing? Is it growing? Is the TVL, that's total value logged, is it growing? Is the number of dApps, decentralized applications, growing? However, with Avalanche, I'm not seeing any of these stats moving up, rather, they are moving down. Developers and projects are leaving the space. Best of the best Avalanche projects are stalling development, including Rocco Finance. Some of the coolest Avalanche games have stopped. So, in my opinion, Avalanche is going through a tough phase. And if they are willing to up their game, if they are willing to provide more incentives to build on their platform, I think they might flourish in the next bull run. But if they are not, we have plenty of options waiting for us, including Sui, Aptos, even Polygon. With all of these systems and their layer 2 solutions and Ethereum layer 3 solutions, ZK solutions, we have everything ready, even in the Ethereum ecosystem. So, betting on a chain which is non Ethereum will be fatal if the chain is not developing further.
Excellent points there. You've opened up a big discussion point around the validity of extra chains. Do we need so many? We got Flow, Phantom, and all the rest, which are non-Ethereum based. Solana throw in there. I mean, the list is huge, but it's a discussion for another time if these use cases can stack up. Now, for our listeners, usually the indicator is developer activity. You touched upon that. We'll check in again in 3 6 months, if not before, to see how AVAX is doing and throw some spotlight onto this one. But let's switch gears and move over to Animoca. They have switched their $2 billion target down to $1 billion. So the company is raising around $1 billion for its new Web3 fund, and they're looking to close that at or within Q1 of this year. So originally, they were a lot more bullish, or their target was double than what they're looking to raise now. I'm just wondering, has investor risk appetite reduced, or is Animoca Brands actually being realistic and potentially not overstretching themselves in terms of commitment and what they can deliver and the users that they're trying to attract?
I would say for a Web 2 VC firm, the best part is to keep their funds at disposal minimum. But that's Web 2. In Web 3, we need to put our eggs in a lot of baskets so that one of the eggs could give us 100 eggs. That's how crypto works, right? And Animoca was hailed as one of the most intelligent Web3 NFT VC firm until they did a lot of mistakes. Their biggest investment, Sandbox, performed 93% down in the last year. Also, most of the NFT projects, most of the metaverse projects all dropped hard because the metaverse bubble was popped. Later, they grabbed headlines by announcing a $2 billion fund just to invest in NFTs and NFT projects. But later, they might have realized that this is not a viable option in the bear market, and now they are reducing the ticker size to 1 billion, which is commendable. Still, they are trying to raise $1 billion to be invested in just 2023. That's amazing. But the risk appetite of investors is going down. And I don't think this is the best time to raise funds or this is the best time to invest in new projects. Why? I believe that these projects will be great in the next bull run, but these VC firms usually have a profit realization game they play quarter by quarter, and they might not even realize it this quarter.
So the chairman of Animoca Brands, Yat Si, has said that several Animoca subsidiaries have raised capital and the interest in crypto still exists despite the shock from FTX and that situation. So he's still bullish, even though that his company is taking a step back or reducing its ambitions. But like you said, 1 billion within the first 3 months of 2023 is still a hell of a lot of investment that he's looking for. I still think that's pretty bullish. And maybe 2 billion within 3 months was potentially a stretch too far. Let's switch gears and into the metaverse. Leaders at the Consumer Electronic Show see possible side hustle in selling personal data. Now, this doesn't sit well with me as it completely goes against the ethos of Web3. What's your opinions on this?
Data is the new oil. Whoever controls data will control the world. That's how it works. But selling personal data has its own consequences, whether it is related to advertisement or it is related to privacy or security. I think selling unmasked personal data has its consequences, and users should really read or understand what they are sharing. If they are just sharing their search histories, that's fine. But if they are sharing their passwords, internet activity that could lead to massive hacks and massive blackmail scams arising in the Web3 space also. This is a distant possibility, but here it is. We cannot ignore it altogether.
Yeah, to me, it just sounds and feels very Web 2 and very centralized. I mean, if we look at the metaverse itself, if there is the belief that people will be transacting, interacting, working, even and relaxing within such an environment, that is where all your data is going to be. Anyway, food for thought to leave you and to wrap up this week. As always, it's been super fun. I'm glad you were able to jam with us today. Until next time, thank you, everybody. We're signing off.